So here on the screen, I've plunked it all into the model for you. I highly recommend you just pause this, take the model that you jotted down a few minutes ago when I introduced it to you, or the equation that is, plunk all these numbers in, calculate it, make sure you come out with the same answers as I do. So what did I do here? Notice I didn't do anything with the market price. We're finding the intrinsic value, and notice that in putting my solutions here, I forgot the hat over the P for the intrinsic value. I do that frequently, and I apologize. I so frequently forget to put that hat on there. So anyways, the intrinsic values of Jimmy's stock, given the three different returns, are as laid out for you on the screen. So the first one, we have the $3.55 last dividend paid, and it's going to follow for all of them, times 1 plus the 5% growth rate. And then the denominators for each are the only things that change. Our R sub S changes from 8% to 9% to 10% in each calculation. So notice that the intrinsic value for this stock varies, and it depends on what the required rate of return is. If an investor requires only an 8% rate of return, the true value of the stock is $124.25. If the investor requires a rate of return of 9%, which essentially means the investor perceives more risk, the intrinsic value is $93.19. And if the investor requires a 10% rate of return, which certainly implies a perceived higher level of risk, the intrinsic value is $74.55. So a couple of things. Number one, notice that as the R sub S goes up, the P sub zeros go down. So notice as the required rate of return, or the interest rate, goes up, the price goes down, just as it did for bonds. It's the same principle. There's an inverse relationship between securities prices and rates of return. And this is one of the reasons I like to use this long drawn out problem in this class as an illustration of that point. So you can really see it in action when you compute something. And then I ask you the question, do you think this stock is a good investment for the long run for someone planning to hold on to it for 10 years or more? Well, sure, probably. It's selling for $75. That's what you were given initially in the problem, the market price of $75. At the required rate of return of 8 or 9%, the stock is selling well below the perceived true value of the stock. If the required rate of return is 10%, well, then the stock is pretty much selling, it's selling for kind of right in there. It's not too far off. It's within cents of its true value. So it may very well be a good buy now because it's going to grow at a 5% rate in the future. So notice how subjective this model is and how subjective it can be to compute a value of a stock. You change one component and you're changing the end answer, and that's how it is with stock valuation. That's what makes it so tricky. So a couple of more thoughts with this problem. C, do you think it's a good investment for the short term? That is, should you buy it with the expectation of selling it in a relatively short period, say a year or less? Well, you don't really have enough information to answer the question, but I'll tell you this and give you this answer. Stock investing should be a long-term activity. If you're going to invest in the stock market, it should be a long-term endeavor. For you, short-term investing is usually seen as speculating, and it's far riskier. It's over the long term that investors can realize the returns that average in the 8 to 10% range over the long haul, over a decade or more. So that's kind of that answer in a nutshell. Questions D and E we'll explore in the next slide. So D says, repeat the calculations of part A, assuming that instead of rising, Jimmy's growth rate remains at 4% or declines to 3%. And then E, comment on the range of prices you've calculated. So let's look at what that looks like for Jimmy's stock. So here are your variables that change that you can plug into your equation when you compute it. You're still using the D sub 0 of $3.55. The growth rate you're going to use is either 4% or 3%, and then you're using 8, 9, or 10% are sub S. So depending on rounding, your answers might vary a little bit, within a cent or two of what I have there for the intrinsic value of the stock, and that's okay. That's not a big deal. So notice that as the growth rate changes in relationship to that required rate of return, the prices change as well. And that would be expected because we're changing another variable in the equation. So you can review to see if you get the same answers or relatively close. These are the answers you should get. For E, comment on the range of prices you calculated. Notice that overall, if you looked at everything you calculated, notice that the lowest intrinsic value you computed was $52.24 for a growth rate of 3% and a required rate of return of 10%. And the highest intrinsic value you computed was $125.25, and that was when the growth rate was 5% and your required rate of return was 8%. So notice how subjective this is. If you change one of those variables, if you change the growth rate or the required rate of return, you change the whole thing. You change the intrinsic value. And that is how stock valuation works. It's not a hard and fast science. It's very subjective. Some comments on dividends now that we've taken a look at computing stock valuation. Dividends may or may not always be constant. It depends on the company, depends on the economy. There are so many factors that influence how a company is going to pay their dividends. They may or may not be constant. Growth might vary. These are real world things. The board of directors is the governing authority of a firm, and they're the ones who decides whether or not dividends are going to be paid. There's no obligation to be paid. There's no obligation for the firm to pay dividends. There's an expectation oftentimes from the investor, and certainly the goal of the financial management team is to create value for the shareholders, and to do that can be accomplished by paying dividends. But just a side note there, stocks that pay dividends are said to be more attractive to investors also in some senses. So just a couple of side notes there. Stages and trends of growth are common. So ups and downs, fluctuations, those type of things, those are very common in the real world, and they're common as they occur for firms. So those are real world things that we see with stocks. So does that mean the Gordon model is ridiculous since it assumes the growth is going to remain constant forever, and that there's always going to be a dividend that's going to be paid for stock? No, it doesn't mean the Gordon growth model can be thrown out into the trash altogether. We use it for a lot of things. It's valuable. The math behind it is great. Helps us do a lot of things to simplify problems in finance. It's just to state to you that stock valuation is subjective. So a note for you on textbook questions and problems that I offer you on the problem set. Do them. Practice, practice, practice. Practice in this class with problems leads to efficiency, and it leads to you grasping the concepts. So I highly recommend you do the problems in the problem set and those in the textbook. I don't cover every single type of problem and every variation, so do work on those problems in the textbook. I don't cover all of them as just noted in the screencasts or in the problem set, but I do have other screencasts posted. I have the preferred stock valuation proof screencast for you, and I also have the non-constant growth screencast, which you should listen to next, and then a screencast to match the problems for you. So use those to your benefit and practice the problems in the textbook. Any questions, let me know, and happy studies.